Hey everybody, Danny Greco, Keller Williams here. Hey, I want to talk about something. We know the market right now, first quarter 2022 is just absolutely insane. Crazier than we've ever seen it. It's always crazy around this time, and just for it to be at the level that it's at now is even more insane. We know that, but what I want to talk about now is looking at possible factors that could slow this market down and comparing it to other markets we've seen in the past. But bear with me, there's going to be a lot of toggling back and forth here. I want to look at a few factors that, if they continue to go in the direction they're going, we could see it leading to a slowdown or perhaps something bigger, but I don't want to be prophetic and announce that I'm expecting this to happen. It's just something to watch for. So let's dig into it right away. There's essentially three variables that could lead to this happening. One, everything, and it's the thing I'm going to concentrate the least on in this topic today. Everything, of course, is inventory dependent. Inventory is enemy number one, variable number one of what's going to, if anything, turn this thing around. But after that, and especially in our Seattle region, I'm going to look at the stock market, and specifically the NASDAQ, which a lot of our local indigenous regional companies are tied to. And then thirdly, mortgage rates as well. So those three variables, I think, will all play a role, some greater than others, in possibly slowing this market down. Let's jump right into it. We all know what a crap show that's been this year, right? So I'm just kind of looking at, here's the S&P. It's February 3rd as I'm creating this, so who knows what happens by the time you see it. Going back to 2020, looking at what the market did then, the beginning of 2020, we saw that ever since the pandemic hit, we saw that, of course, that abrupt shutdown and the markets kind of crashed, but we kind of see that checkmark pattern, right? They really kind of rebounded. But get to the start of the beginning of the year, and the S&P is down about 6% in just 1 month. So quite a drop there in a short amount of time. Let me share your screen. I think is a little more relevant to our region. So what I think is important with our Seattle market is we look at the NASDAQ here. Now, a lot of buyers in the Seattle market are they're tech buyers, right? They work for these companies, and a lot of their pay comes through RSU income, which is a type of income that's derived from stocks, investing, and that sort of thing. It's very typical and popular in the tech community. They're not just paid a straight salary necessarily. As the stock of these companies improves, so does their income and what they can draw from it. So part of this is to show why, again, these companies were not immune to the overall drop we saw at the beginning of the pandemic, but just how much the NASDAQ and these companies like Amazon, Microsoft, Google, Facebook, Apple, all these companies that have a presence in here in our region, whether they're indigenous or not, just how much they've blown up during that time. So think about being a buyer who's kind of on the sidelines wanting to get in, and you're just seeing your portfolio just balloon during this time. Or maybe you're not even a buyer, but you're thinking, well, hell, it's a good time for me to get in the market. Look what I need to do something with this cash that's just I'm pouring out of every orifice in my body here. So the market just went crazy during 2020, right? But in the beginning part of the year, look at this drop down here. And the NASDAQ year to date has lost about 12%, which is a huge drop, even more, about double what the S&P 500's lost. Talked about how these tech people are paid, how a bulk of their pay, or a decent portion of their pay, is derived from these stocks. Take a look at this, which Kyle Burke was the prime residential, a great loan officer who does really, really good stuff with many things, including data and a lot of this stuff. This is just a 12-month percent changes in total compensations. Now, this goes back a little bit, September 2021. But Seattle is really the only major metro city in this group that most of the total compensation employees have is not through typical wages and salaries. In fact, it's only about half of that, which, if you're reading in between the lines, means, these are buyers, or these are people who receive a lot of income other than just wages and salaries, i.e. tech people. So looking at this screen and seeing, okay, there's a lot of people in Seattle who get income from just not typical wages and salaries, and seeing what the stock market has done, especially year to date, it's not crazy to think that, all right, with those incomes and those assets dwindling, maybe people start pulling back. And you don't have to be, tech buyer to be impacted by that. That could be anybody. But if that trend continues, that's something to look for. If it does happen, I think it's going to start at the very top of the price point and kind of work its way down. But if the Nasdaq has dropped 12%, that person who had 100K tied up in that account they wanted to use now only has 88. Not a huge difference necessarily day or night, I get that, but something to watch for. The other factor that, in combination with this and some other variables, could lead to a turn in the market would be the interest rates on there to show you what's been going on. So again, I'm just kind of looking at from the onset of 2020 and the pandemic. We're looking at the blue line here, which is the 30-year fixed rate. This is just an average of Freddie Mac mortgages here. So it kind of started 2020 in the 3.75% range. And then as the pandemic and the shutdown across the world really came in, we just see that blue line dropping and dropping and dropping and dropping. So if you remember from the previous screens, we were looking at 2020. Now we're looking at interest rates dropping throughout that whole time while we saw these stock performances increasing. So not only were buyers being incentivized to do something with their money, make big purchases with their money because their asset, these accounts were just growing crazy with the stocks all ballooning. Now they're seeing interest rates go down as well. And this is what kind of put us in the position where we were end of 2020, all of 2021, where we are now, where people just had all this money. Interest rates were super, super low. And that's what's led to there being so much buyer activity. Inventory's just been nowhere to be found. However, taking a look again at the beginning of the year, and what do we see here? We see rates have really gone from where they ended in 2021 at about 3.11% to now at about 3.55%. So in about a month, they've jumped up about a half a point or so. Hey, I'm not here to complain about 3.5% interest rates. Absolutely not. That is still historically phenomenal, and nobody should be pouting over anything like that. But I think it's worth considering we're probably past these days here. These are probably in the rearview mirror. Getting a mortgage in the twos, probably never going to happen without significantly buying down the rate, which I don't think would make any sense to do. So, however, if this continues to move higher, which we're all expecting it to do based on what we know with the Fed and their attempts to tackle inflation. Now, keep in mind, remember, when the Fed's talking about raising rates, that isn't impacted into the mortgage rates. Those are just the short-term borrowing rates. So don't think of the Fed announcing they're going to raise rates is going to impact your mortgage. These are based on different indices here. So, but we all know that, inflation's double what, double 3.5% mortgage you're getting right now. So that has to come up in order to start bringing inflation down. If we're seeing the stock market go down, interest rates go up, it's only natural to think at some point that's got to apply more downward pressure on prices, right? Yes, maybe no. Bottom line, if inventory does not hold up its end of the bargain, I don't think we really see much of a difference from what we've been used to. And it's really sad to say that, but even just a normal year where inventory maybe increases to what it normally would in the summertime, I think with these other factors going on would really help change or at least slow down the market. So again, it's only early February when I'm shooting this. There's a lot of year left and a lot that's certainly going to change between now and the next month or 2 or 6, whatever it is. So these are really kind of things I'm looking at, because I think right now the market is not only always oversaturated with buyers, but I think there's a lot of FOMO buyers who are jumping in, seeing the writing on the wall with interest rates and thus already oversaturating an already oversupplied buyer market. So if these continue in the trends we're going, is that going to curve, change direction? Who knows? Again, it's all depending on inventory in my opinion. But I think if there's any change that's going to happen, these 3 variables are important to look at. And these two are already heading in that direction, which could spell relief. So we'll just kind of have to wait and see what happens. So anyway, hope you enjoyed this. Again, shout out to Kyle Berquist of Primary Residential. Thanks for that graph there. And if you have any other questions or you'd like to see anything else, definitely let me know. And we'll go from there. Take care.